Welcome back, everyone, to the European VC podcast. Today, I have Alokik with me from Fidelity, but I'm not having this episode alone. I'm doing it together with our good friend Jeppe, who we are doing a ton of episodes diving into the corporate venture landscape. So I hope you'll enjoy this episode as I did making it. We are diving into all the questions that you would expect from an episode that's talking to the managing partner of this CVC of Fidelity, which is one of the main asset managers in Europe. So a lot about fintech, a lot about how a CVC from working out of an asset manager works, and a lot about how the CVC landscape and the VC landscape can work better together.
Here's a few words from our beloved sponsor. Discover where operational expertise meets innovation. With end-to-end coverage across fund admin, tax, accounting, compliance, ESG, and more, we take care of the complexities so you can focus on what matters most. Whether it's supporting visionaries or maximizing returns for your LPs, our tech-driven and comprehensive solutions empower you to achieve your goals with confidence. Partner with ACE Alternatives to streamline your operations and elevate your fund success.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Alokik and Jeppe, welcome to the European VC podcast.
Thanks very much for having me, guys.
Looking forward to it.
Just before we dive in, I want to just make sure that everyone is up to speed with who you are, Alokik, and the firm/company that you're representing. You have a stellar career behind you with both Eight Roads and our good friends of Merrill Lynch and Goldman Sachs behind you. But let's hear a little bit about Fidelity.
Yeah, absolutely. So, we set up this function about 6 years ago, back end of 2018, to focus on making strategic investments with Fidelity's international business based in London. And that's what I've been doing for the last 6 years, investing in early stage fintech that has some strategic resonance back to Fidelity.
And as everyone can then hear, there's a good reason why my good friend Jeppe is with us here, because Jeppe is our co-host on these episodes where we talk about the intersection point between corporations and venture capital. So Jeppe, welcome as well to the podcast.
Thank you so much. Looking forward to this discussion. It's going to be interesting.
Alokik, maybe we could start with a bit of an overview in terms of AUM or investable capital per year or that type of thing, just so people better understand.
Absolutely. So maybe I'll start with a bit of framing. At its core, Fidelity is a wealth manager and asset manager globally. We've been working with the business that looks at that capability outside of the US in general. As a result of which, we tend to focus on those thematics, stuff that touches the asset or wealth world. And then we take fintech and you boil it down to those areas, you're sort of cutting out 60-70% of the ecosystem. So we tend to look at investments starting as early as Series A usually. I'd say selectively, we may do some things in late seed, but I'd say Series A is the starting point. Aim to do about 5 to 6 checks a year. I'd say sweet spot of the first checks are between $3 and $10 million. We're based in the UK, but we look at things quite globally, wherever we have a Fidelity presence or an ability to partner with some of those businesses. And as I said, target sector is sort of fintech only, and even within fintech, we tend to be play closer to home. Some of the notable investments we've made, happy to give you some perspective on that. Names like Moneybox, DriveWealth, Finborn, Smart Pension, Moonfare, Conquest Planning, Xylo, 73 Strings, just to name a few.
I always love to understand better the strategic relevance, so to say. What do you mean when you say that? What do you look for? How driving is this? There's always this balance between pure financial and strategic. So kind of how do you think through all those things?
Yeah, no, it's a really good question. And I'd say different people across the CVC spectrum do it in very different ways. I know some firms that make the investments to quote unquote learn. Some others that do it at the other extreme for financial return and a strategic impact. I would say we're very much at the secondary point, which is we're focused on finding businesses that are going to return capital. And we also want to make sure that they have some strategic resonance back. And so those dual pillars are really key and core for us. I'd say that when we think about strategic, oftentimes, again, corporate gets stuck by making sure everything lines up perfectly just at the same time of the investment and the contract and everything. let's be honest, that's technically impossible. You can do that rarely, but not often. So you've got to do it in the right way and ensure that you're playing for a bit of strategic optionality and ensure that it's aligned towards the direction of where you hope to go and where you hope you can create some impact within the corporate. So for us, I'd say 2/3 of our portfolio have some strategic partnership or collaboration with Fidelity that's live. And that doesn't mean that the other third is not going to get there. It's just not for now.
So how do you do those rationals when you analyze a startup, whether it's a fit for you guys?
Yeah, I always go back to the basics of sort of thematics and research, right? So what we do is, our method, I always describe as sort of joining the dots, right? So we start by joining the dots between the internal ecosystem and the conversations we have inside the building, understanding the issues, understanding the problem statement, and then the external ecosystem of the various conversations we'll have with, a few hundred startups a year and the VC ecosystem and other corporates and other folks that look like us. Then we connect the dots to see, okay, which are those themes that are kind of seeming to be most front of mind, most impactful, most urgent. And we go from there. Then we go a degree deeper and say, like any other VC, we'll go and start doing some research. And that research is a combination of saying, okay, within that theme, what are the specific areas we care about, right? And there may be some subdomains that we think are interesting. And we don't just stop saying, okay, private asset infrastructure is a theme. Like, that's cool, but what do we actually care about underneath it, right? So we'll go in and we'll look at all the different parts of that value chain, from the time someone thinks about investing into private equity through to kind of onboarding, subscription, monitoring, valuation, fund accounting, fund admin, all the way through, and say, okay, which parts do we like? And which parts do we think are going to be impactful and differentiating? Then we meet all the companies in the space that we meet. And that's how we found one of our companies that we back called 73 String, which is right at the heart of monitoring and valuation for GPs.
No, I think that's super interesting, right? But I also think when you sit down and do this thematical approach, right, there's also something about, as you are a later stage, in my opinion, investor, right? Then you have, quite, significant pool of companies to choose from.
Yep.
So how about the monitoring of the companies that will be raising their A, B rounds that are of interest? How do they fit your thematic approach?
I would say it's a confluence of the two. So because we look at those areas, we'll meet companies not only when they're raising specifically, especially because of the strategic impact. I want to meet them when they're not raising. I want to meet them to get to know them. I want to meet them to get to understand their capabilities, the founders, the mentalities, the drive, the passion, and keep monitoring them through that journey. So often we're meeting companies at the seed stage or late seed stage so that we can invest with them at Series A or Series. And we're constantly monitoring these things through usual sort of CRM tools that we use, like Affinity and other things, just to ensure that we're sort of keeping that continuous cycle going. But also where thinking about that strategic impact can potentially take longer. So we want to make sure we're doing that early, not when, the round is forming and we're being given 3 weeks to respond with a term sheet, right? So it's important that we have that dialogue early on to be sort of prepared well enough to ensure that that's the right company and the fit for us, and we can truly help these businesses.
Yeah, for sure. No, and I think, it's also one of the things that you can do for companies, and in the way you also are, I treat you as a CVC in this perspective, right? Is that, how can you help these companies generate revenue out of the Fidelity base, right? That is the key kind of point to get to, right?
Yeah, absolutely. I always describe it as there are 3 things I think we bring to a startup, right? So one is the potential capital, which I think is generally pretty ubiquitous and plentiful, depending on the year and depending on the cycle, but generally available. Then the revenue potential, because that's something that's quite differentiating. And honestly, for many of these startups, that early anchored tenancy, anchored clients is almost more relevant than the capital they can raise. And then the third is the validation and domain expertise, right? The validation that comes from the brand association plus the deep domain expertise that they can get with us is kind of different. And I notice this when you sit around the board table often, right? When you've got generalist VCs that are at some of those board tables, they have a great deal of experience, but coming from a very broad set of different sectors and companies. Literally, we only look at this domain. We only look at asset and wealth. So we go very, very deep on understanding those spaces. And we have the experiences of the pain points and problem statements that we're facing inside the corporate. So we hopefully can bring a different dimension of impact, and oftentimes they're speaking the language of some of the startups.
I wanted to do a bit of side alley talk into businesses that are related to GPs, because I've seen so many, obviously, startups and not too many that reach the late stages.
Yep.
And we had a extreme boom in the formation of these companies over the last cycle. Surprisingly, I think more of them are alive today than I had expected. But I've been looking at it and thinking, this doesn't seem very scalable to me, especially not like, I get why you might have venture as a beachhead market to private equity, because venture is a small asset class. And for that reason, we saw a bigger plethora. There's a huge bunch of these platforms that come from unsuccessful VCs that then decide to build a service provider business to the industry. But given you've invested in both Moonfare and the other company you mentioned, I imagine you have some strong points of view on this.
So it's kind of interesting, right? So both Moonfare and we've looked at the private asset infrastructure space a lot, and I call it infrastructure specifically, not tools. The tools may not be here a long time, but if you've tried to ever invest into private equity or an alternative asset class, the entire experience is really clunky, right? Like it's really painful. Everything from the minute you're thinking about it to onboarding to how your capital is drawn down to how the dividends come in, it's so old fashioned, it's so clunky, it's so painful. And that's just at a microcosm level. You magnify this to large organizations and large investors, it probably just compounds. And then you get this PDF of a report every quarter and you're like, what the hell am I going to do with this, right? So I think the stuff that's more tooling aimed at venture, I kind of put it in three phases. The first set of tooling that I think is not perfect is the aimed at startups. Then you take the tooling aimed at venture. Then you take the tooling or infrastructure aimed at broader industry. So we did Moonfare and partnered with Stefan around his business to think about how are you democratizing access to private equity and that asset class for a much different audience that doesn't have a private bank account at Credit Suisse or Julius. And that's really been interesting and successful. That business has scaled really well, north of 3 billion of AUM. And then we did 73 strings because we're seeing GPs, and let's call it more private equity, private credit GPs, who are dealing with pain and suffering of monitoring and valuation of their portfolio companies on a quarterly basis. Now, if you look forward, that is only going to happen more frequently and more dynamically as you're going down the retail end of that curve, because people are going to want more real-time reporting or near-time reporting. They want a sense of secondary pricing in case that has to transact more frequently, etc. So that need becomes really interesting. And what Jan and Abhishek and team are building at 73 Strings, again, is phenomenal outcome of what they can do given their DNA of coming out of, the valuation businesses in the past. So I think there's things that are, I was also, again, something probably close to home for us. We were investors in CapDesk with Christian and team. Phenomenal business, made a lot of sense in the cap table management in Europe, and that business got acquired by Carta, right? So again, you've got capabilities there that are required by certain companies, but then it's saying a lot of some of the people that came to be the cap table managers or the angel fund kind of syndicate support have now moved into fund admin, because that's giving you more institutional credibility than giving you the sort of small ticket hype cycle credibility. So again, there's different flavors across that question, but hopefully I'm giving you some perspective.
Yeah, and definitely, it makes sense. I also understand the framework that you apply. My question, where I would maybe push back or just say I just saw this plethora of these companies where I was like, this is a platform play. Like, and we're not going to have 7 different providers in Europe.
Right.
And then you had Carta, which I actually, if I'm very honest, I was kind of looking at it and thinking, Carta is so well established, so well funded. Can you really build something that is going head to head with Carta and not just have an acquisition strategy as your exit?
No, I think it's right. And you've seen Carta hoover up a whole bunch of businesses in Europe, in Asia, and beyond. And that makes sense for them, right? You're winning. You need more and more of the client base on the same platform. Then you figure out what other capabilities you sell them, from cap table to valuation to, they've tried with secondary markets. They've tried with a whole bunch of things, right? So I think it's an interesting proposition. But like to your point, you don't need 20 of them. You need 1, 2, 3 maybe. And for us, it became a really interesting strategic angle because Fidelity is one of the global leaders of stock plan services for public companies. But it makes sense to build that relationship before they go public rather than just see them at the point when they're listing. And that was the whole thesis around that cap table management capability. And so there was an interesting partnership that was there in place at the time between CapDesk and Fidelity to try and make sure that they could meet some of those companies that would need to be on a larger platform as they go public.
I'd love to ask you about the later stage market in Europe as well and how you see it. There's some that have described to me that, and you also said this before, capital is typically quite plentiful, but it's not always, for that reason so you said for that reason we need to also come with other things. My negative assessment of it is capital is quite plentiful at the late stages for the good companies, but it's not always from the investors that you would want.
I know. I think it's a really fair question. Look, I to me, especially coming out of 21, 22, you've sort of seen when the tide goes out, who's wearing the swim trunks and who's not, right? So I think that's been kind of the nature. So the companies that are well positioned, got decent scale, either had a very clear path to profitability, were always already there, became the ones that, in the right thematics, became the one that all the growth guys came after. And that makes sense. Then you've got a bit of a crowd effect because everyone wants the same deals and they start bidding them up a little. There's the same folks, say 5, 7 growth investors are the same folks that are going after all these different companies. We see them come into some of our companies. We've seen them around the other ecosystems around FinTech, but it's largely the same people. And it's funny because I was having dinner last time with one of the growth investors who was describing exactly the same thing. He's like, I see the same 5 people against me when I'm putting term sheets to companies, and either I'm winning some of them or I'm losing some of them. So you're right. It's quite a concentrated market and the capital isn't plentiful across the board. Now, is that a good thing or a bad thing, right? If you go through the last cycle we've had, there shouldn't be equal capital or enough capital to support every business.
No. Yeah.
You should have attrition through the different stages and the different A, B, C stage. I felt like through sort of 18 through 22, the failure rate was very low because there was a FOMO factor that was hitting everybody to support every business, whether it was follow-on rounds or new folks saying, oh, I missed that one, but I'll do the second one. Oh, I missed that one, I'll do the third. And so you need a high attrition factor to support only the businesses that are stronger, and that way you play to your winners. Now, this is where I think, again, you have a little bit of a difference. And yep, I think we were talking about this. The notion where your traditional VC model of saying, say 2 out of 10 are my win hit rate, right? Or 1 or 10, 2 out of 10 are like my real hit rate. In a strategic portfolio, sometimes you can have a slightly higher win rate, probably not 100 factor, not 100x win, but you can have a higher win rate going, 4 to 10 times because of the impact you are able to have. And then the validation that provides to the industry. Like I know that in one of our companies where we signed up to be a strategic partner or a client with them, they got 5 calls from competitors of ours and they're saying, great, now we can work with you. Right? And that was fantastic, right? And it helps them tremendously. So that's where they get that validation sometimes from. Right? It's not always perfect, but when it works, it works.
Yeah. There's some interesting elements here, right? Because where we came from was kind of, fidelity in the boardroom and what you contribute with. And now we are talking, growth round, and here you are seen as a CVC, right? So 25% of investments done in growth phases come from the CVCs. But how do you see yourself? Do you see yourself as a VC in this competition or a CVC? Do you face the normal, I don't really want a corporate on the cap table because what about my exit and so forth?
I think branding by badge is almost like in all instances kind of puts you in different camps and different buckets, right? So we are strategic investors, but we're also very financial oriented strategic investors. And the first purpose is to make returns happen for my shareholders, Fidelity. And then we want to make sure we have a strategic impact as well. And that's where we differentiate ourselves sometimes from other folks. Also, we wear the risk. So me and my team, we're wearing the risk and we're accountable to make sure we make the right investments, do the right diligence, we execute the right deals, we write the right checks, we're on the boards and we're making an impact happen and we're making the strategic impact happen. And we champion that inside the building. We don't just write the check and chuck it over the wall and hope it lands by somebody else at Fidelity catching it. And most times it's going to be an egg going splat, right? because of priority or purpose or resource or something or the other that happens in large corp. So that's where I think there's a little bit of a difference. You do face a stigma, and we do face a stigma because oftentimes CVCs are underperforming, or let's call it over-promising and under-delivering, right? And the worst thing you can have is a big brand on your cap table that isn't a client and is not doing anything for you. Then you're truly dead weight. And then the person who's a founder is just explaining to a whole bunch of people like, why is this person on your cap table and they're not even a client? They must really not like you. So what does that tell you in the market, right? And so you have that stigma. I think oftentimes we get this saying at early stages, you don't want a CVC. I actually think that's a bit of a fallacy, saying, yeah, come in later when we're at Series B. Series B, you don't necessarily need that revenue validation as much. Now, I also know that at seed, if I take a seed stage company and I put them through our building, that company will be ping-ponging all the way through the organization. We'll go through 50 meetings of learning and innovation theater, but they'll never get a deal, right? And so it'll take 12, 18, 24 months of sales cycle and they never go anywhere. But at a Series A stage where you've got a little bit of validation, you've got some product market fit, you've got some ability to prove that you can engage with larger organizations, that validation can be hugely transformational. And to me, I always like that dynamic where you're able to have CVCs alongside financial investors in the same rounds because you're able to get the best of both around the board table. So to me, it's complementary. It's an and outcome. It's not an either or.
No, and I think what you're saying there, right? I thought a lot in my early days as a CVC to get on the best deals, right? And I think for me, it was, a lot of mingling with the GPs around Europe. And I think that is where magic happens when you bring the corporate world also into the board and then have it in the combination with VCs, right? But do you do in Fidelity an extra effort to build your co-investor network?
We do. We absolutely do. And we have co-invested with all kinds of folks across the table. The early stage investors, other CVCs, other financial investors, growth investors, etc. We've invested across the board, and we do very actively build that network. And we're very honest, saying this is our space. This is what we know. Think about us within that space. No point having me as a co-investor in a payments deal. I understand it, but it's not my space. I'm not somebody who can make any impact happen there. So if we play to the strength and be honest about the strength, and then also think about how it aligns to the direction of the firm to actually engage, embrace, or drive the outcome. Now, that might not always go perfectly. That might change over time, etc. But at least you're aligned towards that outcome and can truly help that company, right? So I think the toughest times we've had is either there's two outcomes that I think where it misfires. Either you're too early and the company is too early in engaging with a large corporate, or you own too big a stake. If you own too big a stake, even if it's minority, you're basically lender of last resort, and nobody else is going to come in as a co-investor in even subsequent rounds. It's like, oh, you own 30, 35% of a company. It doesn't make any sense. So you've got to get that balance just right, where you want to be minority. And oftentimes I always use this analogy of it takes a village, right? So you need multiple people around the table to make this startup a success. And so you need strategics, you need financials, you need corporates, you need other folks in the ecosystem to all help this company grow and scale.
No, and I think it's getting the basics right? You understand the VC business and how that is done right before you start engaging.
I think that's right. I think
because you're not going to flip it over.
Yeah.
Do you see any places that European corporate venture capitalists maybe don't get those basics right? Where you see might be the ownership mistake or the over-promising, under-delivering. Is there anything that you say, well, this is my message to the market? Could you maybe fix this?
I've been asked by several large organizations who are setting up CVCs, how do you do it? Give us some perspective, do different things. And I always start with the basic question. Why are you doing it? Right? And if the first response is not to make money, it's going to fail. Because that has to be the DNA. Otherwise, you're not at the table with the same mindset. Right? And even if it's the second impact is to bring some innovation in, then to create strategic impact, etc. But the primary principle of investment should be for return. Right? Then you can do everything else around. Right? So that sometimes gets lost. But it's also the incentives. The incentives are miscued oftentimes in corporates, right? Because they don't have skin in the game. in the same way. The investors and the corporates don't necessarily have skin in the game the way the financial investors, the VCs do. So if you're not incentive aligned towards the same outcome and you don't get the downside impact of writing a check and it going to zero, fine. I can
But I
keep
think
doing
it's
it.
interesting, right? So some of the data points we normally use here on the show, right, is that 82% of Nordic CVCs, they're there for strategic gains, right? Or that's what they say, according to a survey, right? And for me, it's a little bit about the hen and the egg, right? For me, I'm here because the average lifetime of a CVC is 3.7 years, right? I need to cure that. For me, when you say, you should be there for financial returns, I totally agree. But it also comes with a quite large financial spend to do a fund, right? Or what are your thoughts on that? How do you then get started if you don't have that, right?
It's so interesting because you must think about it from a returns perspective first. That the impact part will happen, it'll come, etc. But you're kind of approaching the problem slightly differently, right? You don't have to be an investor to be a consumer of the capability, right? You can do that anyway. You can build a partnership if you want to. You can have a revenue share. You can do all these things. You're doing an investor alongside for two different, a level of governance and returns. And
Yeah.
if that's not the case, then it doesn't make sense. It's just really important to get that message right. And that's where I think that, oftentimes you get CVCs that misfire. I also feel, like you were saying, that 3.7 years is kind of an interesting time period, right? It's pretty short. And I oftentimes use this analogy that most times when corporates get into venture, it's out of FOMO when the market is pretty frothy. And then they get out when the volatility starts, right?
Yeah.
So it's kind of reverse. You're almost buying high, selling low, when you should actually be going the long way and staying the course for longer rather than the other way. Then you compound it in financial services with regulation. Then you compound it with bank holding issues. Then you compound it with Basel impacts for banks. You compound all these different things. So it's a wholly different set of factors that financial institutions face on why or how they may be able to hold investment or not. What kind of reserves they're going to have to hold against it. What kind of capital they're going to have to hold against it. So it doesn't always add up in a fundamental way we think about it, but there's ways to mitigate it.
I think many start with the collaboration, right, and then get it from there. But what I really want to avoid is also the corporate startup tourism, right? I see too many, taking their C-suite, flying them to the valley, and then coming back to Europe, and Europe is nowhere near the valley, right?
Agreed.
No different.
And I think it's look, there's certain things that are wonderful about the valley. The level, breadth, depth, speed of innovation is astounding. At the same time, you've got to marry that with two different components in Europe, right? Financial services regulation and GDPR. And you start taking those two different things, and you can take your Valley examples, you can take your China examples, and they don't apply anymore, right? So you've got to figure out the areas we can play for and where we can have the innovation, where we can have the outcomes and things, right?
Actually, let me just ask you, and it's a super weird question to bring in here.
No problem.
But I often hear GDPR as one of the really big critiques of the European Union. Started as a great idea, ended up being really bad for the startup ecosystem. People are likening the AI Act as it started with great ambitions and so on, and many were hopeful. Now it looks like it's going to be a big hindrance. Let me just, because you mentioned GDPR, and I've been wondering this, why is it that GDPR is such a big hindrance for startups? And I'm sure that there's no place where it's worse than in in finance.
Look, I think if you start trying to think about how you're able to create novelty, efficiency, and if you start with like a consumer-oriented example, right? And you want to create better experiences, how have you been able to create better experiences? And let's call it by doing, if you think about some of the componentry across Asia, right? And some of the tools and apps and things that are able to be, because the data flows freely and easily. Now, it's not always a good thing, but the individual and the regulator or government has made a decision that because I'm leapfrogging layers of technology, there's a trade-off between my privacy versus my experience. And I'm willing to trade that off of the privacy versus the experience, right? So several years ago, I was based in Hong Kong, and I was, you talk to some of the apps coming out of different places and in Asia, there was no concept of privacy. Like once you download the app, you give up every information of your phone, right? So where you are, what you're doing, where you're going, etc. And those were being used as components to evaluate your credit or your financial resiliency. So I think there's different elements of it. I think across Europe, you take a view that you're trying to protect the consumer, you're trying to protect the individual, and privacy is still very, very important. It's like a fundamental tenet of culture, right? So I think that's the trade-off. Now, for a young company, okay, if you take in financial services again, let's take open banking, right? Open banking was a big revolution that came across UK and Europe and still has been. It's very much at the forefront versus anywhere else in the world. Now, if you can take that and expand it across financial services whole, you unlock just a huge level of sort of inefficiency and inertia that sits in a whole bunch of different pockets, because then an AI can be very well served, an agent can be very well served with all of your data around all of your financial services and insurance, lending, mortgage payments, savings, investing, and then give you advice. That's way more powerful than all the data silos that it sits in individually because of the way the regulations.
Yeah, I'm sorry I asked such a stupid question.
No, it's not at all.
Because I was literally thinking about something my wife said the other day, because I thought, what the fuck? Because she said she saw that something for our kid or son, that they had his full name together with his picture, and she was like, well, at my school we're not allowed to do that anywhere. Full name and picture. Then try and build AI on top of that. Like, can't access anything that has like just that.
That's interesting, right? That's interesting.
Alokik, you said something in the beginning that I would like to double click on, hopefully a little bit smarter. You said that when you are looking at, to basically form your thesis on where you want to look for startups, because this is one of the principal differences between probably both a growth stage investor, but also being a specialist versus a generalist. You are building theses that you go out and find the companies that fit. I'd love to ask you to dive a bit more into that, because I know a bunch of VCs that do the same, but they are, so to say, building on the back of large networks and their own research, but not on the back of a large corporate's understanding of the world and the problems that exist.
So I would think that we're kind of doing both combined, right? It's really important for us to be able to think about domains that are going to be relevant to Fidelity in the future. So I always think that we're looking out forward, whereas the firm is thinking about the next 1 year, 3 years, and planning some of that. As I said, that the method I always use is sort of joining the dots logic, right? And so how are we informed by the internal and the external? And we come to some people. At any point in time, we're not really doing more than 6 or 8 big themes, right? And then, what we do is we take 2 people on our team and we say, okay, go deep on this particular theme. Let's research it. Let's meet the companies. Let's talk to others. Let's talk to specialists, talk inside the building. Let's get an understanding of the dynamics of that area. Why is it interesting? Why is it now? What is the pressure points? What is the need? What's driving the outcome? And is it a large enough opportunity that companies are going to sort of create outcomes in this space, create new startups in this space? And then we boil it down. So, I'll give you another one. This is, again, highly relevant in Europe, not that relevant in the US, definitely not starting from January, but let's talk about sustainability. Right? So in sustainability, we looked at it and we said, okay, what are the areas that we think can be relevant to us as Fidelity, but also in Europe and in financial services? And so we said, okay, there's a lot happening in ESG, but let's look at some of the thematics that could be relevant. So we looked at carbon accounting. And carbon accounting, both at the corporate level and at the sort of SME level. Where does it make sense? How does it look? We met a whole series of players in this space, and we backed one out of France called Green. Alexis built a phenomenal business, growing and targeting the SME market and going up the curve. Then we said, okay, let's think about some of the credit risk that's involved in the carbon trading. Now, that's still quite a nascent market. And there's 2 major players in that space, largely between Silvera and B0. And we joined the round as a co-investor alongside Bolderton and others in the Silvera round. Again, carbon credit. So again, that was another vertical we spent a bunch of time. The other one we spent a bunch of time on was transition risk and portfolio risk around climate change. And again, here we looked at a whole series of players. We came close to making an investment, and we decided not to at that stage because we love the vertical, we love the space, but we weren't able to touch that back to the Fidelity research analysts and PMs as how is this going to help me generate alpha? Like, it's a great input, it's good to have, but I can't create an alpha generative element out of it. So probably not that urgent for me now. So that informed us of a good way to think about some of that outcome. So those are some of the areas that we think about that make sense. But, there's many other elements of that sustainability point. We also back to Mello, which is a retail proxy voting in the UK. So that's allowing the end investor to express the vote on whatever the topics are coming up from, the AGMs, but allowing that to go directly to the end investor and not stop at the asset manager. And that's Georgia's business. So I think, again, there's so many different elements of the way we've been thinking about it, but because we play with our lens, we're able to think about the direct uses and application.
Maybe a question from me here: when you have these or this thematical approach, right, which I've also used in the past, right? So one of the key sources as a corporate investor here is unlocking that strategic value. Could you maybe share a little bit about how you work with the employees at Fidelity you do have access to, and how they help you create these themes?
So I'll give you some very concrete examples. If I look at my calendar and some of my teams as well, I'm sure I'd say about a third to half of my time would be engaging with people. Of the time I spend meeting people is probably engaging with people in the ecosystem within Fidelity, all different parts of the world. And that's just regular chats and catch-ups. It could be somebody in the multi-asset portfolio management side. It could be somebody on the UK personal investing side. It could be somebody in technology, somebody in operations, etc. All different parts of the leadership. And just having a chat. What's on your mind? This is what I'm seeing. This is what on my mind. This is what we're seeing out happening in the market. And we just exchange some of those thoughts. And that helps sort of spur the understanding. So it's not coming to them at a time when I have a deal. It's happening in regular course of sort of what's on your mind and what are we seeing and what are they seeing.
Do you liken that to a managing partner of a VC firm's LP relations management?
It is kind of, though the LP is not giving you ideas of what to invest in. An LP wants to know your performance, your reporting, and when you need the next check, right? And when is it coming back to me?
Luckily, we have some more value-add LPs as well. In the ecosystem,
Yeah, absolutely. And look, when you have strategic LPs and many people are going towards that element, that makes a lot of sense, right? So I think some of that is that conversation, but also it's some people who are literally at the cold face of the industry doing this function every day, trying to figure out what's harming them, hurting them, or what the opportunity.
No, and I think one of the interesting parts when you do this and work this way, right, is there are two things that I've actually wanted to ask you out of this, right? The not invented here syndrome. How do you handle that within Fidelity, right? Because I have faced that so many times in my past, right? Don't touch the we can build it, right?
Yeah.
Don't.
So there is a lot of bias within that. Again, playing for the slightly smaller international business gives you a little bit more degrees of freedom, because then it doesn't all have to be invented at home. We don't have infinite resources to be able to build everything. And there's a level of an intellectual curiosity to just see what's happening outside. You do face a little bit of the not invented it here, or, yes, we can build it, because engineers and devs want to build stuff, right? And they want to build cool things. They don't want to support the legacy tech. They want to build the new tech, right? Same ways as everybody else. I think when you come from showcasing or allowing people to engage and see the leapfrogs versus current and what the potential is, what the next generation of, their competitors are doing, what other folks are doing in the ecosystem, etc. You're able to show them how far away you may be from future. And then the only way is to leapfrog, because at that point in time, you may not even have that capability in the build. I go back to a company we have, again, a Canadian company called Conquest Planning. Conquest Planning is AI-driven financial advice. And this is not trying to do it direct to the end investor. Yes, they can, but they're trying to power the financial advice. So IFAs, RIAs, those kind of things. They started in Canada. This was the team, Mark, Brad, and Ken. They built a company, they sold it, they built it again on a modern tech stack. So they've done the exact same thing before. They know who's the buyers. So they're really dominating the Canadian market. They've they partnered with us and others to try and anglicize the product for the UK market. They've partnered with BNY for the US market. And the company's doing really, really well. But again, here, it's like when you can showcase that capability versus thinking about how a traditional IFA is going to think about engaging with the client. It's usually you sit down with somebody for an hour, they ask you a whole bunch of questions, you bring a whole bunch of paper, then they send you this big file or a PDF of 50 pages, giving you all your perspectives and risks and things, and then telling you what you should be investing in the future. Right? These guys are trying to dynamically show you some of those actions based on a next best action for you. When they understand your model, show you the glide paths of what you're investing, where you're going to fall short. Okay, I dynamically change this in the conversation with you. So it improves the interactivity and engagement with the client real time. Not that we send you a PDF next week, right? So I think it's those kinds of things that you can see the step change, right? So when you can see the step change, you can help engage the outcomes. But I think you have to start from a level of intellectual curiosity, not intellectual arrogance. Because if you're in intellectual arrogance, you'll always think you can do it better.
Yeah, and then I think it's also about building the trust between the CVC arm, right? And
I think that's right.
Right, because if you do not adhere to that trust, then you will not get anywhere. The other question that I wanted to pop to you also was, around you shared about, how much time do you spend with your core colleagues, right? So when you build your own team, so how do you do that? How do you basically say, do I need somebody from inside that has those connections already? Or do I go outside and find the VC resources that know how to create a deal? How do you balance that?
It's really interesting because most of our team has been built homegrown, I would say. And it's quite a mix of capabilities. Some came from a little bit more investment experience. Some came from corporate. Some came from consulting. Some came from banking. I think generally we want people who have the base core skill sets of being able to sort of understand investments, valuations, models, and a bit of financial analysis. I'd say even though we start at Series A, we're probably err on the more analytical approach rather than the sort of the feely approach. And we do a lot of work on every deal. We do a lot of work, detailed memos, detailed everything around all of it. Most of my team has been with me from the time we started this in 2018. And then we brought in junior people and grown them internally. And it's been interesting because they themselves have built up a depth of understanding of the verticals they go into, the teams who are supporting them at Fidelity, and they've grown with the domain expertise that we've developed as well. So, and I think, the way we generally do things is any two people are always on a particular thematic. So you build double domain in each space. So you've got a bit of resilience in that outcome. But I do think like the same way I interact with a lot of the organization, they would interact with a lot of the organization continually, and just having those chats, catch-ups, and understanding with different aspects of sometimes showcasing something new, sometimes asking for feedback, sometimes giving perspective, sometimes challenge. I always used to describe myself that in most meetings where I'm pulled in with the rest of parts of Fidelity, my job is to challenge or to showcase the difference that's outside the organization, right? So sometimes people get tired of hearing from me, but my job is to usually challenge the status quo. So be like, that just gone, right? We've got to be a better way to do so.
Yeah, and it's not an easy task, right? Because if you find someone that is too eager to go out on the startup side of it, right, then they forget to get the learnings they need from the corporate that they actually need to put into the boardroom later on, right?
Exactly.
Because so that balance is super important to get right.
I think that's right.
Can I finish us off with a bunch of quickfire questions that I love your take on?
Sure.
What is the main thing that's on your mind these days when looking at Europe?
Exits. Are we going to have a healthy enough ecosystem to support many multi-billion-dollar exits? Are they going to have to be strategic buyouts or listing?
What do you see are the key steps that we need to take to make the growth stage part of our ecosystem in Europe be better and stronger?
I think more. So growth stage becomes stronger when you've got repeatability. So it comes from the pattern recognition. It comes from folks who've done it before, and it comes from founders who've done it before, and people to show them the way to go forward. So I feel like it's kind of a little bit of a circular reference and a little bit of a sort of a flywheel effect, but I think we're getting better. And as we have some of the generation of companies that have grown and matured, especially in the fintech space, we're seeing some that have, got into some pretty lofty valuations, some that are exiting, listing, that will create that good impact of showing the path of what may be possible or what may be, repeatable for the next generation to come through.
Can I actually jump in here? And because something came up from the previous question. So on the exit side, right? So I had a discussion back and forth with one of the GPs that I love the most, right? And it's like, big corporates need to buy companies, right? And I'm like, can we get, my opinion was then, can we get some European GPs that are concerned about knowing the head of M&A for all European corporates, right? What is your kind of take on that, right?
No, you should do, right? It depends. It depends on the domains and the spaces, right? I look at our portfolio. We've got 25 portfolio companies, so 24. Most of them will be strategically acquired. I'd say a subset may be listed, but I don't believe all of them because as Andreas, you were mentioning some of these, right? How much of them are capabilities that will max out at some point, rather than be large enough to be listed, right? So, and I think that's the reality. But I do think that there would be more strategic buyers. I think when you start thinking about some of the major factors that are impacting the industry, and we've got, in our industry across asset and wealth, you've got a few different things, right? You've got margin pressures, you've got cost pressures, you've got active to passives, you've got people needing to bring a whole set of capabilities together. And then you've got these two giant, underpinnings across both of them. One is intergenerational wealth transfer, where there's some, 50 trillion that's going to transfer across over the next couple of decades. And then you've got AI. So you add all that together, there's a lot to play for. But sorry, that's not a rapid fire answer, Andreas. I'll come back to that.
No, I loved it. And I want to rapid fire questions. I don't want to rapid fire answers. You take all the time you need to give me answers. I have a final one.
Sure.
It's a curveball. What makes you the most exciting or most excited and the most fearing for the future and the year we're headed into?
The most exciting is the scale and pace of advancement we're seeing in some of these foundational technologies and the time we're in. Now, each generation feels the foundational technologies are revolution, right? Whether it was mobile or web or cloud, I think the AI transformation can be revolutionary. And at the first instance, we're seeing it at the efficiency layers. Next, we'll see it at the revenue layers as well. And I think that's going to be really, really, really impactful. And again, if you look at it just through the lens of our lens, which is investment research, portfolio construction, portfolio management, you have the ability to create some pretty phenomenal outcome that can have long-lasting impacts across the industry. Fearful is uncertainty and geopolitics, right? Because those are the ones that have the ability to throw curveballs. We already have multiple things happening all around us in the world. We have even greater polarization of impacts between certain markets around the world. Those are the things that harm levels of innovation, because especially in financial services, it's usually boundaryless. The nature of financial services should not be designated by boundaries or servers or cloud computes, right? So I think those are the things that would worry me about it, and nothing you can control. We just got to try and get to a more peaceful state of the world.
Beautiful. Alokik, thank you so much for joining us. Jeppe, thank you so much for joining to co-host yet another episode where we dive into corporate venture.
No, loved it, guys. Thanks very much for having me. Appreciate it.
Here's a few words from our beloved sponsor. Discover where operational expertise meets innovation. With end-to-end coverage across fund admin, tax, accounting, compliance, ESG, and more, we take care of the complexities so you can focus on what matters most. Whether it's supporting visionaries or maximizing returns for your LPs, our tech-driven and comprehensive solutions empower you to achieve your goals with confidence. Partner with ACE Alternatives to streamline your operations and elevate your fund success.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.